The special language of property. So, if you're new to property, well done. You understand the true value. You're wanting to build out your passive income. You're wanting to build out your streams of income. You're wanting to improve your cash flow. Ultimately, you're probably wanting to increase your wealth. Well done. Now, if you what I would class as like a white belt, so white belt, beginner, new to property investing, understand a few bits and pieces, but obviously want to get started, this video should really help you. So I'm just going to cover 10 acronyms, really, what you'll find or you'll hear bounced around a lot in the property space. So before I do get into it though, make sure you hit the subscribe button, because about 70-80% of people that watch these videos don't subscribe. So again, please hit the subscribe button. It'd do us a massive favor. And as always, write on piece of paper, whatever it is, notes, just make a few notes. And obviously the best thing, what we always tell our mentees on the Black Belt Property Academy, is go over your notes, okay? Keep educating yourself continually. Anyway, the first one, you've probably heard of this, BMV. So the first one, BMV, stands for below market value. So again, lots of people always say, right, you need to get the property BMV, you need to make sure it's 25% BMV and so on. Fantastic advice, it really is, because you want to make sure that you're locking in profit from day one, okay? You want to make sure that you've already bought equity, as it were. So one of our latest deals that we've done was up for 99,000, and we secured it for 75. So that was a really good example, really, of pretty much getting approximately 25% BMV. So you always want to make sure that you're locking in profit from day one. Now, again, some of the mentees speak to us and say, well, I can't find them in my area, I can't find them in other areas. Properties being snapped up like this. That is the case. It definitely is. But there are still out there, trust me, okay? It's just about understanding and knowing what to look for. So the first one, BMV. So hopefully you understood that one. Second one, JV. So you'll hear that as well. Joint venture. Now, a joint venture could be between one and two people, two or three people, whatever it is. Basically, I suppose it's a partnership, really. So you could JV a couple of ways with people. You could be the one that has the money, they have the experience, or the other way around. You have the experience, they have the money, or it could be 50-50. So there isn't really, a set process for JVs. It's just when, I'm going to use two people get together with the ultimate aim of, again, something to do with property. So to increase the cash flow, to build out the equity, to maybe flip the property and then go halves on the uplift, whatever it is. So when you hear the word JV, I remember when we were first starting out years ago, you'd hear the letters JV and you'd think, there's so many different JVs, which, what does it all mean? Basically, when you're doing a JV with somebody, it could be, it's you and another person. I'm going to use that for an easy example. And you decide amongst yourselves who's going to do what, who's going to bring what to the table, what's the exit plan, and so on. Now, again, I wouldn't do it on a handshake. I'd make sure that it's all properly written up and so on, done properly through solicitors, but that's the main process. You both need to agree, how we're going to tackle this, what we're going to do, how we're going to get our money out at the end. Are we looking to flip it? Are we looking to refinance? Then I'll pay you off and then I'll keep the property, whatever it is, okay? But the main thing is, you're looking for two people to get done what obviously one person couldn't get done. That's the main premise underneath it. So that was JV. Number 3, ROI. So ROI is a fantastic one. Obviously, us with our mentees want to make sure that they're clearly understanding the numbers. So ROI, return on investment. So again, if you're from a marketing background, you'll definitely understand that. So you're spending £1,000 on marketing, it brings in £2,000 of new business. So what's your return on investment? So again, that's a fantastic return on investment. It's pretty much one for one, £1,000 out and £2,000 comes back in. So you've got your original £1,000 plus another £1,000. So that's a brilliant ROI. So your return on investment is normally how much you're going to put into a property. So, it might be 5,000, it might be 10,000, whatever. If you're looking to JV with somebody else, it might be 20, it might be 25, whatever. What's your return on investment? That's going to be your ROI. So if you put £100,000 into a property, say for instance, you're lucky enough to have 100,000 in your account, well done. You must be doing something right. You then just go and put it all into one property, which I'd never advise. You put it all into one property, and then your return on investment is going to be, let's say, again, for argument's sake, £10,000 rent per year. Your ROI loosely there is 10%. Now, again, we're crossing over into gross yield and net yield type of stuff, but again, this isn't meant to be meant to be a highbrow video. It's just, you know, hopefully helping some of the beginners out there, really. So that is ROI. Next one, LTV. So when you're looking to purchase a property, again, you might purchase it through a bridge at first if you're doing the BRRR method, or you might just go straight out and purchase it through a mortgage. Now, if you're looking to purchase it through a mortgage, currently, and it has been for quite a number of years now, the owner, you need to have what we class as like skin in the game. You need to make sure, or the lenders need to make sure you've got skin in the game, so the risk isn't all on them, that there's 25% of equity, of your equity in that deal. So again, let's just go for basic maths. If you're looking to purchase a property at 100,000, the lender will require you to have 25% in. So 25% of 100,000 is 25 grand. Okay, so the LTV is 75%. Now, on some, like the one we've just completed on at the moment, the lenders would allow us to go up to 80% LTV. That's something we never do because we want to make sure that we don't overgear ourselves. But it's always nice to have that option. We're always keeping it at 75%, some of them at 70%, and so on, because we don't want to overgear ourselves. So LTV means the loan to value. So again, if you're looking to purchase property at 200,000, you or your JV partner, whatever, would need to put in 25%, which is 50,000, and then the remaining 150,000. Again, it's still 75%. It's a 75% loan to value. So again, any more experienced investors watching this, you understand that this is all basic stuff too. But what we always class on the academy as white belt investors, hopefully, this is providing some value to you. Now, again, there's a big chapter of this in my upcoming book, quite a big section, really. I think there's 25 acronyms, and it's all aimed, again, keep your eye out for the book. It's all aimed just to help investors move along and, again, hopefully achieve financial freedom and build the life and live the life that you want to live, and especially if you're in the 9 to 5 rat race. Next one, ILA. ILA stands for Independent Legal Advice. So if you're buying in a company, which is often better. Again, I'm not an accountant, I'm not a solicitor, just telling you stuff based on my experience. So if you're buying through a company, which is, your company, Mr. Smith Properties or Mr. and Smith Properties, whatever it is, if you're buying through a company, you will need to sign as well a PG, which is a personal guarantee. And when you're signing that PG, it will obviously, the meeting with your solicitors will be down as like the providing you with independent legal advice. So that's where the ILA comes into it. And that basically is the solicitor telling you that if you default on the mortgage, even though the mortgage is in the company's name, you're still accountable for it. So that really, again, it's covering their back. It avoids you racking up all this good debt and then not paying, and then, dissolving the company, but then not held accountable for it. So I'm sure if you're watching this, especially if we're like 9-10 minutes in, you're professional, you're looking to build out your income, you're looking to build out your wealth, well done. You've got, all intentions really to pay that mortgage. So signing a personal guarantee should be no problem at all, really. So ILA is independent legal advice. Now, if, this solicitor's over here is doing the sale of the property, unless they're quite a big solicitors with numerous firms, you normally have to go to another solicitor where they can provide you with independent legal advice. They will then send that personal guarantee over to your solicitors who sorting out the purchase, and they can tick that box. So just be aware of that, okay? Next one of our favourites, definitely, and this is something we'll really try to drill in with our mentees, ROCE, ROCE, Return on Capital Employed. Now, if you're like us, a massive part of our portfolio is boring vanilla buy-to-lets. We always do BRRRs on those, okay? So we always wanting to buy them below market value, do a decent refurb, push through the ceiling price and pull out as much money as possible. Now, the slight difference between return on investment and return on capital employed is, again, I'm just going to go for easy maths. If you put £50,000 into a property, and then you've obviously managed to refurb it, that includes your deposit, stamp duty, legals, and the refurb costs. So if you put, again, easy maths, £50,000 into it, but you managed to pull out another, let's say, just half it, £25,000, in theory, you've only got £25,000 of your money left in that property. Now, if you manage to do it even better and pull out, say, for instance, fantastic, you put in 50 and you've got back out 50, that means that literally there isn't any of your money still left in that deal. So that would mean your return on capital employed, lots of people refer to it as being infinite, because there isn't actually any of your money in that deal. You've pulled it all back out, but yet that property, if done properly, will pay you each and every month. And that's what it's always about. Okay, so that's always what you want to achieve. The return on capital employed, the higher you can get that number, the better. So one of our recent deals now, I'm just referring back to that one that we purchased for 75. So with that now, we've got about 11.5/12,000 pounds left in that deal. Now, some people might think that's a lot of money, that's leaving a deal. If somebody said to me 20 years ago, in 2007 when we first started, obviously inflation adjusted, you're going to be able to put in £12,000 into a property, it's going to cash flow £350 every month, and you're going to get your money back within 3 or 4 years, and then everything after that is additional. Have a look at it this way. It's like you're purchasing property for 12,500, and then you controlling that property, and it provides you each and every month, as well as the debt remains fixed and inflation is going to erode it, whilst in the long run, especially through the property cycle, we'll do that in another video, it's going to increase in value. So your return on capital employed is something I definitely suggest you start to research more. In fact, we've probably done 1 or 2 videos on this channel. Hopefully you've subscribed. If you haven't, make sure you hit that subscribe button. Have a look into it more. The next one, BRRR. Now, you've probably heard of BRRR, and again, if you're hearing any of the Americans refer to it, they'll always class it as like the BRRR strategy. But BRRR is you're just knocking off one of those as buy, refurbish, rent out. That's it. That's pretty much what we did for the first 3 or 4 properties pre-crash 2007, 2008. We bought a property, we probably didn't even refurbish it, really did loads of things wrong. Might have threw, a bit of magnolia around on walls and stuff, and then rented it out. So we didn't really know any other strategy other than, right, let's put our money in there. Hopefully the tenant's going to pay us on time. Fantastic. And again, I mentioned lots of mistakes that we made during those early days, and lots of our mentees know that, because I want them to learn and understand that we've all made mistakes, and it's about us failing fast, failing forward, but ultimately learning from them. Now, the best strategy, okay, that we always suggest new beginners get into is a BRRR. So you're going to buy the property, you're going to refurbish it, you're going to refinance it, then you're going to rent it out. So BRRR, it's a fantastic one. And this is, again, you'll have heard of things like momentum investing, managing to pull your money back out. I'm going to sneeze in a minute. I do apologise. Excuse me. I'm going to be very unprofessional though and carry on. So with that now, the BRRR though, buy the property, refurbish it, refinance it and rent it out. The ultimate aim there is to pull as much money out as possible. But then again, all of that boils down to the research stage and you doing your proper due diligence. Because we can speak to agents who will look at a property that looks fantastic, really old, really dated, hasn't been touched in 40 years, needs a new kitchen, needs a new bathroom, needs new gas central heating, the gardens are overgrown, all ticking boxes. However, it could be up for 180, but yet one further down the street is sold for 200 or 210, and it looks really, really good. And then you think, well, if we're going to spend 25, 30, 35,000 pound on it just to bring it up for the amount that we've spent on it, it's a bit of a pointless task. What you want is to pick up that same property for 160. So you've already then £20,000, you've bought that equity, you've locked in profit from day one, and then done your refurb to a decent level where you've understood your fixed costs and added where needed to, decent finishing touches, and then managed to push from the current ceiling price of 220 to 230 or 240. So it's about understanding how to purchase at the right price, how to do your refurb at the right price, but still gaining maximum value for the amount you're spending, and then again, how to refinance. So I know this is supposed to be an acronyms property language there, but again, BRRR is something we definitely know inside and out, really. And the last one for today, AST. I know I've jumped around a little bit here with these acronyms, but an AST, assured short hold tenancy. So when you're letting your property out now, this isn't SA. So again, I'll probably cover SA in another video. When you're doing SA, serviced accommodation, they're not tenants, they're guests, a bit like you're a guest in a hotel. However, when they're actually moving into the property and they're obviously going to pay the council tax, the other rates, the utilities, and so on, and they're living there, ongoing, then they need to sign an AST. Now, if you're outsourcing this to a managing agent, fantastic. But be aware that they're going to take 10% plus VAT. So if you're running like some of our properties at £750 per calendar month, that means the managing agent takes the 75% plus adds on then VAT, which is about another £14, something like that. So that £75 really then becomes 90. So instead of us getting the 750 minus the 90, so we're going to get like 750, 660 or something like that. Excuse me. So going back to it, an AST is something that they need to sign to make sure that everything's legal and done properly and so on. Now, again, I'm not going to go into the full ins and outs of what your managing agent or what you should do if you're managing yourselves. We'll create another video for that, really. But hopefully those, I think there's 10 there I covered, helped you along the way. I know I jump around a lot, but I want to make sure that hopefully you're gaining some value and obviously it's helping you. But one thing, again, I know I keep mentioning it, you've got to have that black belt mindset of, I'm going to keep getting up, I'm going to keep showing up, and having that Kaizen mindset of continually improving all the time. Do we know everything? Of course we don't, okay? We know quite a lot, but we know that there's always the next level to achieve, and that's the same mindset that we want with all our mentees. You move in at white belt, then you move to yellow belt, then you move to orange belt, and at each time you're getting more and more experienced, and you notice that the more experienced you become in, deals are better, your margins are better, you're managing to pull more out, your cash flow's increasing, your wealth's increasing, and so on. And it's having that black belt mastery mindset, really. Anyway, thank you very much for watching. Make sure you like this video. Like again, one more time, hit that subscribe button, please, if you haven't already done so. And check out the rest of the videos on this channel here. We tend to put out 2 to 3 a week, as well as quite a few shorts. So hopefully you'll find some valuable content on here. Good luck. Watch out for the book as well. And yeah, take care. All the best.